Have you ever heard the term options trading and just felt your eyes glaze over? It's always talked about like this super complex, high-stakes game that's only for the pros. But what if I told you the core ideas are actually way simpler than you've been led to believe? So that's the big question, right? A lot of folks just steer clear because they think you need to be some kind of Wall Street genius to even dip your toe in. But honestly, when you understand the fundamentals, you'll see that some of these strategies can be really powerful tools, even if you're just looking to protect your investments or make a specific bet on where the market's headed.
Okay, here's our game plan. First, we're going to nail down what an option even is, the big idea. Then I'll give you a simple 5-step roadmap for getting started. We'll dig into the 2 most basic bets you can make, explore 3 straightforward strategies, and then we'll wrap it up with a no-nonsense look at the pros and the cons.
So let's start at square one. We're going to strip away all the confusing jargon for a minute. What are we really talking about when we say an option? Now listen up, because this is the most important part of this whole explainer. See that phrase? The right, but not the obligation? That is everything. Think of it like this. You put a deposit down on a house. You now have the right to buy that house at the price you agreed on, but you're not forced to. If things change, you can walk away. You lose your deposit, sure, but that's it. In options, that deposit is called the premium. You're literally just paying for the choice. And that choice basically comes in 2 flavors. You've got a call option. That's your bet that a stock's price is headed up. You want the right to call that stock over to you at a lower price. Then you have the put option. That's the total opposite. It's your bet that the price is going down. You want the right to put your stock onto someone else by selling it at a higher price. It's that simple. Calls for up, puts for down. Okay, so the idea itself isn't so bad, right? But how do you go from understanding the concept to actually, doing it? Let's walk through a responsible way to think about getting started. First things first, you have to be real with yourself about your goals and how much risk you're truly comfortable with. Step 2, you'll need to find a good broker and get approved for options trading. They'll want to know you have some idea of what you're doing. Third, and this is crucial, you need a plan. Know when you're getting in and when you're getting out. Fourth, be aware that taxes on options can be tricky, so do your homework. And last but not least, step 5, this is not a set it and forget it kind of thing. You have to keep learning and always manage your risk. And now for the fun part. Let's look at how you can use these tools, the calls and the puts, to actually make a move based on what you think is about to happen in the market. So when you're buying calls, the key word, the magic word, is leverage. You think a stock's going to soar, but maybe you don't have enough cash to buy a ton of shares. Well, with a call option, you can control the same amount of stock for just a tiny fraction of the cost. And that means your potential gains can get amplified, big time. Let's make this super concrete. Say you've got $5,000 and you invested in Apple stock. The price pops 10%. Awesome. You just made nearly $500. That's a 10% return on your money. A totally respectable trade. But just hang on a second. What if you took that same $5,000 and instead of buying the stock, you bought call options? With that exact same 10% jump in Apple's stock price, your profit could have been almost $10,000. That's a 200% return. That is the raw power of leverage in action. It creates what they call asymmetric returns, where your potential for reward is way bigger than your initial risk. Now let's flip it. What if you're convinced a stock is about to take a nosedive? You could try to short sell it, but that's incredibly risky. Your potential losses are theoretically infinite. Yikes. A much safer way to play it is by buying a put option. The absolute most you can lose is the small premium you paid for the option, but you still cash in if the stock drops like you thought it would. So, once you get comfortable with buying calls and puts, you can start combining them into some pretty clever strategies. Let's check out 3 of the most common ones. Okay, first up is the covered call. This is a huge favorite for investors looking to generate a little extra income. The idea is, if you already own at least 100 shares of a stock and you don't think it's going to shoot to the moon anytime soon, you can sell a call option against your shares. Someone pays you a premium for that option, and you just pocket that cash. It's a fantastic way to make your portfolio work a little harder for you. A protective put is, well, it's pretty much exactly what it sounds like. It's protection. Let's say you own a stock. You love it for the long run, but you're getting a little nervous about the next few months. You can buy a put option, which acts like an insurance policy on your shares. It basically puts a floor under your investment, so you know your losses are limited if the price suddenly tanks. And this quote right here just hits the nail on the head. Thinking of a protective put as insurance really is the best way to understand it. You're paying a small fee, the premium, to protect a much more valuable asset from a potential catastrophe.
Now, this last one is pretty cool. Imagine a company has a massive announcement coming up, like an earnings report or a court ruling. You are sure the stock is going to make a huge move. You just have no clue if it's going to be up or down. Well, with a long straddle, you don't have to guess. You buy both a call option and a put option. If the stock explodes upwards, your call pays off. If it craters, your put pays off. As long as it moves big one way or the other, you've got a shot at making a profit.
All right, we've seen the power, we've seen the potential. It's exciting stuff. But let's be real. Options trading is not some kind of magic ATM. It is absolutely vital that we look at both sides of this. Time for a reality check. Let's really break this down. On the pro side, you've got that incredible potential for high returns. That leverage can be a game changer. And when you're buying options, it's a huge plus that your loss is limited to what you paid. But, and this is a big but, look at the cons. This stuff is complex. That same leverage that can make you a hero can also make you a zero really fast. It multiplies your losses too. And if you get into selling options without owning the stock, well, your risk can be literally unlimited. This is not a place for guesswork. Okay, so let's boil it all down. What are the absolute key takeaways here? Number 1, options are about choices, rights, not obligations. Number 2, they give you leverage, which is a powerful two-edged sword. Number 3, there are strategies for any outlook, bullish, bearish, or even neutral. And number 4, the most important of all, you must understand the risks before you even think about putting real money to work.
So, at the end of the day, it all comes down to this one question. Options aren't good or bad. They're just a tool. And whether they're the right tool for your toolbox, well, that depends entirely on your knowledge, your comfort with risk, and what you're ultimately trying to achieve with your money.